Welcome back to Investing Talk Podcast. Today we're focusing all our attention on Banzai International. They operate that AI-driven virtual event marketing platform. And the central question, really, for every investor looking at this is Banzai International a good buy right now? Before we unpack this really dynamic situation, please take a moment to subscribe, like, and comment on our channel. And hey, if there's a specific company you'd like us to look into in a future discussion, definitely leave us a comment below. We do read those. Okay, so our mission today, it's straightforward, but honestly, pretty challenging. We're going to try and synthesize all the available info you shared with us. We need to balance that extremely bullish analyst sentiment against some very real financial risks and the key events coming up soon. The goal is to help you form a more informed opinion on Banzai.
Yeah, and what's fascinating here is just the sheer tension in the data, isn't it? You've got these external analysts painting this picture of almost, well, unbelievable success, but then the company's financial reality, it's still very much rooted in that high-growth pre-profit stage. It forces you to kind of reconcile this high-flying story with the cold, hard numbers.
Okay, let's start with the market optimism then, because it is intense. We're looking at a consensus rating of strong buy. Now, granted, it seems to be based on just one covering firm currently, but still, that signals a highly favorable view of the story, right?
Right, and this is where the conversation usually stops people in their tracks. So we saw back on September 30th, Ascendiant Capital reiterated a buy recommendation, and they put a one-year target price of an astonishing $87.98 on it.
$87.98.
No, yeah. Now, when you compare that to where the share price was actually sitting around, what, $3.05 in early October, that represents a premium of nearly 3,000%. To be precise, 2,944% upside.
That percentage is just, it's so high it almost sounds made up. Is this target grounded in, well, anything realistic? Or is it just an extreme bet on massive future success that might just never happen?
That's the key context, exactly. Look, targets like this from a single analyst, especially for, microcap AI growth stock, they aren't exactly common, but they represent a belief in a complete valuation reset. The idea that Banzai will achieve scale, hit profitability, and basically be valued like a much larger SaaS firm within just 12 months. It's definitely a moonshot projection. But importantly, if you step back from that, like extreme outlier, the wider Fintel average target, it's a more moderate, but still highly optimistic $14.79.
Okay, $14.79 at least sounds a bit more plausible. It still suggests significant upside if they execute well.
Exactly. It provides a much more reasonable measure of potential upside.
So the target's aggressive, sentiment's positive overall. Let's look at why the charts might be backing this up. What are the technicals telling us about momentum?
Well, the technical analysis definitely supports the short-term enthusiasm, regardless of which price target you actually believe in. The stock's been consistently trading within a bullish channel. It's been making higher highs since August 2025. That trajectory alone suggests maybe some institutional interest is returning to this name.
And we should look at the moving averages, right? Those are pretty critical indicators of where the price might be headed. The current price, hovering around $3.05, is sitting just above the 50-day simple moving average. For our listeners, the SMA, the simple moving average, just shows the average price over a set period. Crossing above the 50-day, which is at $3.02, confirms that recent performance is pushing the stock up.
Yeah, and even more decisively, the price is well above the 200-day SMA, which sits way down at $1.83. So maintaining a price above both those key moving averages, that confirms a strong, sustained upward momentum trend. And on top of that, short-term momentum indicators are signaling a pretty clear bullish forecast.
Okay, specifically things like the positive MCD, right? The moving average, convergence, divergence. That just means the short-term price trend is kind of pulling away, accelerating from the longer-term trend, indicates momentum is building.
Correct. And based purely on that momentum, projections are suggesting a range of maybe $4.30 over the next, say, 1 to 3 months. So that's an upside of 15% to 41%, just driven by the technical interest and buying volume we're seeing.
Okay, so we've seen the market's enthusiasm. The chart signals look positive, but for that momentum to actually hold, and for those higher price targets to even be remotely possible, we need to look under the hood, right? What do the Q1 fundamentals tell us about the long-term viability of this company?
Right. The foundation for the bullish argument really rests on two main things: top-line growth and efficiency gains.
So in the first quarter of 2025, their quarterly revenue hit $1.82 million. That represents a massive year-over-year increase, about 86%.
86%. Wow.
Yeah, that kind of velocity is exactly what the market wants to see from an early-stage SaaS platform, especially one riding the AI narrative. And management clearly believes that pace is sustainable. because they reaffirmed their 2025 revenue guidance. They're projecting between $9.0 and $10.0 for the full year.
Mm-hmm.
That implies they expect really strong sequential growth in the next 3 quarters to hit that target.
Exactly. And crucially, they aren't just growing, they seem to be getting leaner too. Their gross profit margin improved to 73.1% in Q1 2025. That's up from 70.6% the year before.
Okay, so better gross margin. That shows they're getting more efficient at actually delivering their product, which is vital for a software company trying to scale up, right?
Absolutely vital. You want to see that leverage over fixed costs.
And are we seeing that efficiency translate down to the bottom line? Any progress towards, the holy grail of profitability?
We are seeing progress. The net quarterly loss narrowed significantly. It came in at $2.5 million. Now, compare that to a $4.9 million loss in the prior year quarter.
So they nearly cut the loss in half year over year. That's pretty substantial progress.
It is. And if we connect this to the bigger picture, their balance sheet offers a pretty strong foundation for managing this period before they reach positive cash flow. They report a strong net cash position, $7.3 million in cash and cash equivalents, and importantly, negligible long-term debt and low total liabilities at just $2.1 million.
Okay, that clean balance sheet, that's definitely attractive, especially in this market where capital can sometimes be tight. What about the cash burn? Is the moderation sustainable, or was Q1 maybe just a temporary tightening of the belt?
Well, the data suggests it might be sustainable. Operating cash burn dropped quite a bit, from $4.18 million down to $2.12 million year over year.
Okay, that's a big drop.
Yeah, it's a significant moderation. It extends their runway quite dramatically, and furthermore, their current ratio is over 3.5x.
Right, the current ratio. What does a 3.5x ratio mean for the average investor listening?
It basically means the company has exceptional short-term financial health. For every dollar they owe in the next 12 months, they have $3.50 available in short-term assets, like cash or things they can quickly convert to cash to cover it. So that gives them strong liquidity, strong resilience if market conditions were to, unexpectedly tighten up.
Okay, so tremendous growth, improving efficiency, robust balance sheet. This looks like a powerful narrative, doesn't it? Until we hit that inevitable profitability hurdle, they are still losing money.
That is the core friction point, absolutely. To justify those aggressive valuations we talked about earlier, they absolutely must clear the profitability hurdle. And analyst projections for 2025 still forecast negative non-GAAP EPS of negative $0.41.
Okay, negative 41 cents. And just quickly for listeners, non-GAAP EPS.
Right. It's non-generally accepted accounting principles earnings per share. It's basically the company's preferred way to calculate earnings. They often exclude things like stock-based compensation or other non-cash items. So even using this arguably more favorable adjusted metric, analysts still project losses for the full year. They also forecast negative EBIT, that's earnings before interest and taxes, of around $5 million for 2025.
So still burning cash on an operating basis.
Yeah, they're still relying entirely on that continued aggressive top-line growth to eventually, hopefully, offset those fixed operating costs.
Okay. Beyond the profitability timeline, the sources you shared detail some confusing institutional volatility. This might be the biggest sort of sticking point in the whole story.
It certainly raises a really important question. What's puzzling is the really sharp shift in institutional support reported in the most recent quarter. Institutional shareholding apparently dropped sharply by 98%.
98%. That's almost a complete exit.
Pretty much. The number of holders reduced drastically from 21 down to just 6. That signals major risk adjustment, or maybe rotation, by large funds. Many seem to have just liquidated their entire position.
Okay, but given the strong revenue growth and balance sheet improvements you just laid out, how do we reconcile that? Why would institutions bail like that?
Well, it gets even murkier because there are conflicting signals depending on which source you look at. While some reports show that mass exodus, Whale Wisdom actually reported institutional ownership increased by 22% in the second quarter of 2025.
Okay, wait. So one source says down 98%, another says up 22% in roughly the same period? How does that work?
It's confusing, right? It suggests major funds are sending completely different signals.
What could possibly explain that kind of split? Is it maybe large specialized growth funds rotating in while smaller, maybe higher risk institutions are just getting out completely?
That's probably the most likely dynamic, yeah. The 98% drop might reflect smaller funds, maybe specialized risk funds, entirely closing out their positions. While maybe a few larger, more stable funds, or perhaps index-tracking funds, might have been adding exposure during the quarter, maybe seeing value in the lower share price. But this lack of clear consensus among the so-called smart money It makes tracking fund positioning extremely challenging for the retail investor. Very muddy picture.
Definitely murky. Okay, beyond fund flows, let's quickly touch on the core company-specific risks that Banzai has to navigate.
Sure. The first big one is customer concentration. A significant chunk of their revenue comes from their top enterprise clients. So if contract renewal rates weaken, or if just one major client decides to switch to a competitor, that creates a major risk to their growth forecast.
Okay, heavy reliance on a few big customers. Makes sense.
Yeah.
What else?
Second, as we kind of touched on, the entire model relies on continued, really aggressive top-line expansion to offset those fixed costs until they hit scale. That puts enormous pressure on every single quarterly report. They have to keep delivering that growth.
Execution becomes absolutely critical then. Which brings us neatly to the near-term catalysts. These are the events that are likely going to dictate the company's trajectory over the next few months. And there's one event that really stands out, doesn't it?
Absolutely. The most critical event on the calendar is the Q3 2025 earnings release. It's expected around October 24th, 2025. Investors will be watching that report intensely for proof of concept. They need to see continued strong revenue growth, evidence of cost containment that accelerates the path to profitability, and crucially, encouraging forward guidance. Basically, they need to validate all that enthusiasm, or the momentum that drove the stock above those moving averages could stall out very quickly.
Okay, so October 24th, Q3 earnings. Mark that date. Are there any other, maybe more technical dates that could influence trading volume or sentiment?
Yeah, a couple to keep an eye on. Mid-November 2025 brings the potential for ETF rebalancing. If Banzai International gets added to or adjusted within certain indices, that could influence institutional demand and passive trading volume. But perhaps even more important is the institutional ownership filing deadline, the 13F filings, which are due December 4th, 2025.
Okay, the 13F filings. Tell us exactly what that report will show the listener. Why is December 4th important?
So the 13F filing is a quarterly report that institutional investment managers with over $100 million in assets have to file. It lists all their current equity holdings. So when that report drops in December, it should clarify whether major funds are rotating back in after seeing the Q3 performance, or if the capitulation, that 98% reduction we saw reported earlier, is actually continuing into the second half of the year. It gives us concrete, albeit slightly delayed, data on where the big money is actually positioning itself. It cuts through some of that conflicting noise.
Got it. A clearer picture on institutional sentiment by early December. What about softer indicators? Insider confidence? Are the people running the company putting their money where their mouth is?
It looks like they are, yeah. We see recorded insider open market purchases totaling about 55,000 shares. These happen between $2.10 and $2.90 per share across July and September 2025. That does signal executive confidence, putting their own capital on the line near the current price levels. Meanwhile, retail sentiment seems to remain pretty robust. There's positive engagement across financial forums, suggesting a dedicated, maybe hopeful shareholder base. Okay. And finally, the area that always generates the most excitement and, frankly, the most risk, the high-risk, high-reward speculation swirling around the market.
What unconfirmed chatter is out there that could lead to, explosive upside if it actually materialized?
Well, there are a few recurring, but again, unconfirmed rumors that could potentially trigger a massive short squeeze or a big valuation spike. First, strategic acquisition talks. Banzai could either be the target, maybe a larger player wants their AI event capabilities, or they could be the acquirer looking to broaden their product suite rapidly.
Okay, M&A chatter. What else?
Second, unconfirmed partnership initiatives. Specifically whispers about a partnership with a larger SaaS company or maybe even one of the top 10 cloud providers.
Wow, okay. A partnership like that would instantly legitimize their technology, wouldn't it? And give them massive distribution access.
Oh, absolutely. An announcement like that would instantly validate their platform, expand their reach overnight. Huge catalyst. And finally, there's the hope that often precedes major price jumps. Speculation about expanded sell-side coverage. Getting initiated by a major investment bank could significantly improve liquidity and institutional appeal. It introduces the stock to a whole new class of investors who often only buy following those major bank recommendations.
But these are all just rumors at this point, right? High risk to trade on.
Exactly. All currently just rumors and should be traded with extreme caution. Pure speculation right now.
Okay, so let's try to synthesize all this highly conflicting information. It really is a fascinating battle playing out, isn't it? Between high ambition and, well, cold reality. We've got that analyst optimism that near $88 price target is hard to ignore and strong technical momentum confirming short-term interest.
But That optimism is heavily weighed against the ongoing operational losses, the immense pressure to keep delivering 80% plus growth, and that highly volatile, frankly uncertain institutional support picture. The execution shown in the upcoming Q3 earnings report, it really feels decisive, like a major turning point.
Ultimately, this company seems to represent a classic high-growth, high-risk scenario. The whole investment thesis completely relies on continuing that top-line expansion and achieving profitability sooner rather than later. It makes it potentially attractive for maybe two types of investors: short-term players driven by that Q3 catalyst, and maybe long-term believers in the whole AI sauce growth story.
Right. However, we have to leave you with a provocative thought as you consider your own strategy here. Given that drastic drop reported in institutional ownership, that potential 98% reduction in holders, how much weight should you, as an investor, actually give to a single analyst price target of nearly $88? That really is the core risk-reward tension here. It's a question you absolutely must monitor closely as we approach that December 4th, 13F filing deadline. That filing will finally give us some much-needed clarity on where the big money is truly positioning itself for the longer term.